Mortgage interest rates are now 5.5% and the housing market continues to climb. But housing affordability is at an all-time low. We've got a lot to talk about and it's all coming up. Stay tuned. Hi, this is Warren Oberholser. This channel is all about what's going on with our current real estate market, both nationally as well as in our greater San Francisco Bay Area. So if this sounds interesting to you, please hit that subscribe button so you don't miss anything. In this video, I'm going to talk about the effects the current rising mortgage interest rates are having on the housing market and what to expect as the year continues. In CNBC's article that was just published a couple of days ago, they stated the average rate on the popular 30-year fix started this year at 3.29% and hit 5.55% on Monday, according to Mortgage News Daily. The vast majority, 95% of 100 largest U.S. housing markets are now less affordable than their long-term levels, up from 6% at the start of COVID pandemic, according to Black Knight data. If rates were to rise just 50 basis points more, or home prices were to increase just 5% more, home affordability would be at the worst on record. Okay, a lot to discuss here. Let's start off with mortgage rates. They just hit their highest level since 2009. This is the game changer I've been talking about since the last 6 months. What's interesting, I predicted that once we hit 4%, we would start to see the market react or slow down. It actually did the opposite. It heated up. In fact, I posted a video on this in February on what I got right and what I got wrong in my predictions. So I didn't think that 4% mortgage rates would crash the market as far as, foreclosures and short sales. And I made that very clear. What I did think would happen, it would slow down the amount of purchases or purchase offers coming in. So when this would happen, it would reduce the number of offers and therefore stop the bidding wars or reduce the number of bidding wars. And I can tell you, as far as firsthand experience from my own listings I've had in the last couple of months, it was just the opposite. Yes, we had multiple offers and they went over asking as much as 16 to 20%. Now, I know that each market is different, especially if we do a cross-section nationally. Where I'm located is the Northern California, San Francisco region, and more specifically in the East Bay Tri-Valley area. Going back to my listings, as I said, I received multiple offers. And, these were, I call hot offers. They came in, all of them, by the way, with all contingencies released up front. So, and by the way, they were all financing too. That's something I didn't have any cash offers. So the challenge for me as a listing agent to do my due diligence was to make sure that the buyer was whole for their offer. Now, what does that mean? Well, I would, because again, they were all with a mortgage. So I would actually call the loan agent up and say, hey, I received an offer from your client, and I would tell them everything about it. I want to be clear with you, there's a good chance that this property will not appraise. And then I'd say, hey, in the event it doesn't, does the buyer have additional proceeds besides their down payment to bring forward to make the offer whole? Now, as I've discussed in numerous videos, when an appraiser comes in to appraise a property, they always look in the rears. They want to see what has closed in the past, even if it's just a few weeks or days before this property was on the market and is in contract. They really don't care about pending properties that may be like properties that are at the same purchase price that your home is in, or your property that you're going in contract for. They only care, or the only thing that they can put in their appraisal report as far as understanding numbers to give to the bank, are properties that have closed. Yes, they'll list active, they'll list pending, but as far as the actual numbers, as I understand from an appraiser, it's built off of properties that have closed. What is interesting is when I do speak to the loan agents, many of them are very forthright, and they'll tell me up front, you know what, they have enough for their down payment and closing costs, but that's going to be about it. So we're just hoping everything appraises. And I said, well, that's great, but they have released their appraisal contingency up front. So I just want to make sure that your client are aware of the possibilities that could happen. Now, in this market, most loan agents get that, but I have had a few people taken off guard, loan agents taken off guard. And they're very professional. They said, let me work on this and I'll get back to you. And for that discussion, I've actually had some offers canceled. They weren't accepted, but they just said, we're going to pass. We're not going to go forward because of the possibility of what could happen. And we have released the appraisal contingency where my buyer decided they're not comfortable to move forward. Now that interest rates are at 5.5%, and there's a good chance they're going to continue to go up, we need to see if this will affect the housing market and how. Housing inventory continues to remain at a record low. I feel a possibility from this is offers will still come in, but just not as many. And the ones that do will have their contingencies in place. This means if the buyer's financing, the appraisal and the loan contingency will be intact as a stopgap in case there's a problem for the buyer. And again, I said all three contingencies, which would include the investigation. So there's a good possibility that the buyer will start requesting from the seller a request of repairs. So they may say, hey, clear the section 1. That's if there's any issues with termites or damage to the wood. They may say, hey, there's a health and safety thing. We want to clear that. Doesn't mean that the seller has to agree to it, but it means that they can negotiate for those things. Getting back to the appraisal and the loan, let's say that the property doesn't appraise and the contingency for the appraisal and loan, especially the appraisal, is still intact. In other words, they haven't been released up front. Then the buyer can go back to the seller and say, hey, we need to negotiate. You need to lower your price to what the property appraised for, or, we can maybe split the difference. The point is the buyer now can negotiate with the seller. It's not just the buyer rolls over and accepts, anything the seller says. So this would equate more of a balanced real estate market. We'll just have to see. I think we're also going to start to see more buyer remorse as the year continues. What does buyer remorse mean? In real estate, it basically means the buyer's questioning, did they make the right decision on the purchase price? This will result in properties canceling. You'll see back on the market. And this can happen, right from the get-go. The seller accepts the buyer's offer and the buyer gets cold feet. And then, they tell the buyer's agent, no, cancel. Or, and this is more traditionally where we'd see that, is they do run inspections. They look at the report and they go, the seller, won't repair these items. Or the seller may agree to, but the buyer may go, look, I don't want to buy this home. It's got these issues, especially with the pool, or let's say there's something with the foundation. The last thing that I think will start to happen too is getting back to the appraisal. If the buyer and seller can't come together on that, and when I'm saying the property doesn't appraise, I think the seller's just going to walk, and the buyer's just going to walk, and they can, and they'll get their deposit back. Because again, I said that if we start to see those contingencies in place, because this means the seller's market's starting to get reduced down, then the buyer has options, and one of them is they can cancel and take their deposit and go to another property. So what does this mean? Are we looking at the market crashing? No. The current homeowner, as I've said numerous times, is in a very stable place. Most of them have a low mortgage. If they've been there more than 5 or 6 years, 10 years especially, they have lower property taxes. So their monthly, expenses are pretty comfortable. They can stay there indefinitely. But homeowners, as a kind of a sociological thing, they want to sell, they want to move, they want to do other things. And I don't mean just get out of California. I mean, they may want just a bigger home. They want to be what we call a move-up buyer. So what I'm saying is this will actually, I feel, equate to a more balanced market. So that could be a good thing. It'll cost more to purchase a home, which is not good. I wish we could keep the interest rates lower, and I think in time they may settle down. If you like this video, please give me a thumbs up. Post your questions and comments down below, especially if you're a buyer. Let me know what it's been like with you. If you put an offer in recently, has it gotten accepted? Tell me about that. We'd love to know. And if you haven't subscribed to my channel, please consider doing so you don't miss anything. If you found this video interesting, you may want to check these other 2 videos that are starting to pop up just about now. So stay tuned. I have more helpful videos like this coming soon. Please reach out to me for any of your real estate questions or needs, and I wish you all the best on your home journey.